Great. We'll start our today talk, which is a continuation of the talks that we started on the SIAM activity group on financial math and engineering. As you know, the talks are happening every other Thursday at 1 p.m. For past talks, all the information, please visit the wiki page. And we're trying to reduce the number of messages we are saying and bombarding you. So that information is always there. Before we proceed with this today talk, just a general reminder that we'll have somewhere in the middle of the talk a pause for quick questions and more questions at the end where you can ask them either in the chat box or in Q&A, and I'll read them to the speaker. Or if you prefer to talk, let us know and we can turn your mic and you can ask live the questions. Besides that, there are panelists, which are all the SciFin board members, editorial board members, and some other people that are promoted, but that's just the difference is minor. Finally, the last remark, the organizational remark, is that we decided that at the end of the talk, once we are done with the formal part, the talk and the Q&A, we'll keep this meeting and the room open for additional half an hour. So, you know, to compensate for what we are missing and to have an informal, literally off-record meeting where you can ask questions, the speaker, chat among us. So please stick around after the talk. So now I think we are ready to move to the today's speaker. And it is my definitely great pleasure to introduce Bruno De Pere, who is the head of the quantitative research at Bloomberg, that he joined in 2004. Prior to that, he was the head of the derivative research group at Societe Generale, and prior to that, also head of research group at Paribas Capital Markets, managing director at Nikko Financial Products. In addition to that, he is the fellow and adjunct professor at NYU. He is in the Risk Magazine Hall of Fame, as well as the recipient of Risk Magazine Lifetime Achievement Award, and many, many more accolades, which will be, you know, long to list. Besides that, of course, Bruno is known for his pioneering work on local volatility models in '93. Well, commonly that we call De Pere's equation and De Pere's formula. Another fundamental contribution that also sort of bears his name is functional ethos calculus, introduced in '09, also known as De Pere's functional ethos calculus. He is also running the Bloomberg Quant Seminar, which is one of the largest seminars on quantitative finance. And today, Bruno will speak about the geometry of money and the perils of parameterization. And with that said, Bruno, please, and thank you for coming.
Thank you very much, Igor, for this very nice introduction. So, hello, everybody. So, I think there is some crowd, even if it's an invisible one, but hopefully we'll have some time by the end to share more questions and viewpoints. So today I will talk about the geometry of money and the perils of parameterization. So the main idea, and I think it's quite an important concept, it is that financial institutions are trying to avoid arbitrage by using parameterized forms to make sure that things are properly aligned and not out of whack. But actually, there is another set of constraints, which are the dynamic arbitrage to be prevented, which unfortunately don't seem to be satisfied most of the time. So we are going to go through this. But to understand that, we need to understand some geometry. So we'll play with concepts like, for instance, convex hull, separation theorem of Brunner, and it's quite, I think, an interesting topic, and it allows also to shed some light on some strategies like statistical arbitrage, and actually it has some links even with things like SVM of machine learning. So let's get started. So, yeah, okay, sorry, here. Yeah, so markets market participants are using parameterization, and it's kind of inevitable because you price in real time thousands, for instance, for the derivatives world, but it's the same thing for different bonds or very many different securities like term structures of futures and these kind of things. But you have, for instance, thousands of stocks. Each one will have tens or hundreds of options, and you have to make sure that all the quotes you provide are pretty much aligned to avoid being trivially arbitraged. So to continuously update your quotes, typically the market is using different parametric forms. So market is evolving continuously, so obviously you have to readjust those parameters. And the problem is to know whether it is creating some arbitrage consistency issues. So it's linked, if you prefer, to also to the problem of recalibrating a model. When does it work and when does it not work, and what should you do? So let's look at an example, which is, for instance, the swaption market. The swaption market, so it's quite a rich one because you have to define three parameters. It's the maturity of the option, it's the tenor of the swap, and the strike, which is the fixed leg of the swap. You agree to, you have the right to enter. The market is very clearly following parameterization, actually from the Sabre model of Padhagen. And here I show you an example of the fit you have of the market to the Sabre model, of the Sabre model to the market. And actually, it's not innocuous to have the dog or the whale, the tail wagging the dog. Actually, in that case, it's more the model determining the shape of the market. So it means that market makers are typically using this parameterization. So what is it, the Sabre model? So I think you know it. It's a stochastic volatility model. It's not a very good one to depict the dynamics of the stocks, of the forwards, but it has the great virtue of having a decent analytical approximation. So it's shown in the bottom here, this kind of complicated equation, but it's very easy to code and super fast to run. So this is why the market has adopted the model. You have adjustments now with negative rates, you have to shift it. And it has been a whole industry actually to try to improve this equation because it's an approximation and typically it behaves badly for long maturities and low strikes. But it has become the norm of the market. Here it's an example of parameters of the model. And within the model, it's important to understand the distinction between state variables and parameters. Parameters are supposed to be fixed and they guide the dynamics of the state variables. Like in Black-Scholes, for instance, a parameter would be the volatility and state variable, the stock price. So here we're supposed to have a given model with static parameters, but actually when we look at the value of these parameters through time, we see that they spend their time changing and with possibly big moves. So that's the question, the type of questions we'll address here to see whether it is creating a problem or not. So it could be just a conceptual problem that it's uncomfortable to work with a model where you're supposed to have fixed parameters and they move, but the most important issue is to know whether it's consistent, or whether it can systematically generate arbitrage opportunities. So obviously, arbitrage opportunities, most of the time, they will be erased by the bid offer, but still institutions with large books, typically, and managing their risk, tend to look at the mid value of the things. And it's important to understand the behavior that is required in the case of a frictionless market as a central reference to decide what is admissible or not. So here it's another example. So here it was the VIX, the VIX index and the futures actually during a very violent period. So it was actually 2 years ago, in February 2018. The spot VIX, so this is actually this red line here, in the space of less than 1 hour, from here to around there, it doubled up a bit more, basically from 23% to 46%. And still we'll see that the market behaved very nicely during this time. Let's look at those graphs. The two graphs in the bottom refer to the VIX futures of two different maturities, 4 months and the second one. So here in, the most important thing, it is this, the red curve here, it's an implied volatilities, the S&P options as a function of the strike. So here it was a quiet time here, but even during and this is the second maturity, and you see that everything has doubled up tremendously here. Actually, the blue lines correspond to the out of the money option prices, so the puts on the left hand side and the calls on the right hand side. And essentially the VIX squared is the area under this blue curve. So again, if I go back to the one before, we move to this. But still you see that all the implied volatilities are very nicely aligned. So even during a strong market disruption, the market is still very, very tame in terms of the respecting the smoothness. I have an even more recent example here. So this was during the past month, so 2 months here within 1 month. So it's the two lines here. So it's February, actually 3 months and 2 months ago, between February 18th and March 16th, in less than 1 month. It moved from a very natural low level. So actually the VIX was at 15%, and it beat the historical record, closing at more than 80. I think it was 86% intraday. And you see that it's a tremendous difference between this is on the left-hand side, on the bottom, it is February, and March on the right-hand side. Very different levels, but still everything is pretty much aligned. Sorry. So here. So now, I want to show something else here to move to this. The proper. So now we move to this geometry of the portfolios of arbitrage, or if you want, loosely speaking, of money in general. It's based on convex analysis and very much so on the Brunner theorem. So I go with a quick presentation and very sort of toy examples, a very trivial one, but with 3 interesting applications. Okay, so first, Unbanner, the geometric form, essentially tells you that if you have two convex sets that do not intersect, then you can separate them by a hyperplane. So hyperplane in this example here, it would be very simple. It's just a line. If you're in dimension n, so it's a hyperplane of dimension n-1, but the beauty of the theorem is that it applies as well in infinite dimension, even if you need a Zorn lemma for in general, so a certain form of the axiom of choice. Another way to look at it is to say that you can create a linear form that would be 0 on the hyperplane and positive on one set and negative on the second one. Oh, sorry. So let's look at first a modest form of the Unbanner, the little Unbanner theorem, I call it, in low dimension. So imagine, I'm sorry. Yeah. So here we look at, for instance, a payoff, an option that gives you at time t, a payoff which is this blue curve. So what are, under the current spot price is x0. The question is, what are the possible prices, arbitrary prices of this contingent claim, knowing that the spot price is 0, and to make it simple, we assume no carry terms, so it means no rates, no dividends, no repo. And we assume that the trading instruments are 0 coupon, means a constant, or the stock price, which is the linear payoff. So basically, you know the price today of affine payoffs, and there will be no intermediate trading or hedging. So to get the arbitrage-free prices, you first look at the convex hull of this blue curve. So this gives you this the red shape here. So you can see it as a rubber band wrapping as tight as possible this this blue curve, and then you take the intersection with this vertical line that goes through x0, and this intersection gives you the lower bound and the upper bound of the possible arbitrage-free prices of this curve here. So to understand how it works, imagine that you could buy it for a lower price than the lower bound. Here is the lower bound. And if you can buy it for alpha, so you can separate this convex set, the red set, which is a convex hull, from a second set, which is just this point here, with the x value being the spot price and the y value being the price of this contingent claim. So you could separate by this line here. And what does it mean? It means that in that case, we interpret this line as a hedge. So typically, you would sell this combination of 0 coupon and stock, and you buy the claim. So you make some money initially because you sell at a price which is above alpha. And so you receive this and you pay only alpha. So you capture some premium if you want initially. And at maturity, so your position is blue minus yellow, which is positive as well. So in that case, we apply the Unbanner theorem in this trivial situation, but it could be an arbitrary dimension. But what is important is that the space in which we operate here will be a space of possible scenarios of the price of trading instruments, including your target instrument. Now we look at a big Unbanner one, the base of the FTAP, the fundamental theorem of asset pricing. In that case, we operate in a space of contingent claims, and the separating hyperplane actually will be interpreted as the kernel of the pricing functional. So if you want the costless the claims with a price of 0, and it can be interpreted also as a pricing risk neutral measure. So the cone here, it's the positive claims, the claims giving you a positive outcome in any state of the world. And this line here, it's the claims with an initial price of 0, a market price of 0, let's say. If you prefer, the contingent claim that you can attain from a wealth of 0 initially. So we have two convex sets that do not intersect because of the absence of arbitrage. A point in the intersection will be a positive claim with 0 price. So they do not, it's two disjoint convex set. We can apply the Brunner theorem. So it means you can separate by, in that case, it's a plane if you conceive it as a 3D structure. And we can interpret this as the kernel of a pricing functional. So typically it means in that case, the pricing functional will give positive price above, negative price below, and 0 prices on that plane. Once you have a pricing functional, you can infer from it a measure. So you define a measure, a probability measure by the probability of any set. And here it would be, we define for a subset of scenarios A. So the probability of this subset would be the price of the value of the pricing functional on a contingent claim, which is the indicator function of this set. So Q of A would be the pi. So now you could have actually, in our case, it was not complete. You may have different separating hyperplanes. So when you have different ones, it corresponds to the situation where you have several equivalent pricing measure, multiple measures. And so it means that in that case, the price, it's only the price of the attainable claims that can be determined with uniqueness, and for the other ones, you have just a lower bound and the upper bound. Okay, now third application of the Brunner, what I call the quasi-Brunner principle. So it would be in the case where you cannot really separate the two sets, but you try to separate them optimally, like for instance with a SVM super vector machine. So here we look at an example here with two tradable securities. So VIX future contract and VSTOXX futures. So it means the index of implied volatility, the futures on the implied volatility index in the States, and the same thing in Europe. And you can look at the behavior, the joint behavior. So every day in the past, when those contracts were live, so you can look at the joint value. So it appears as a point in the scatter plot. So these cloud of points describe the past behavior. And so if you assume that you have a strong relationship, structural relationship, and so in some sense, some co-integration between the two. So basically, you can make the assumption that the most likely values are represented by these cloud of points. So if the value corresponding to today is this yellow point here, so essentially you will try to build a portfolio that makes that is likely to make money. In this case, so you try to separate the current point from the cloud of point. Here you don't manage to do it exactly, but what does it tell you? It tells you that most of the points are on the half space, and actually you can interpret the line here, the red line as the isoprofit scenarios of a certain portfolio. So in other words, to the line you can associate a portfolio such that it would make money if you go down here and lose money if it goes up. So this is very important, and this geometry here will be used for our parameterization analysis later. Okay, so sorry, I have to flip from different ones. Sorry, so portfolio geometry here. Let's look at it in a finite dimension. If you have n assets A1, AN, so their price at time t would be the small letters here. So t is the time index and I is the asset index. So if you have a portfolio, so the portfolio is a combination of this, it's a sigma of alpha I, AI. Alpha I are the holdings, and the price is given by actually this dot product. So it's sigma of alpha I, AI, T. So it's a dot product of those two vectors, the weights and the prices. So it means that it defines a linear form and a hyperplane where there is no change of value, and it defines half a space where the portfolio increases in value and the other one where it loses value. So the price gradient is given by the alpha vector, defines this isoprofit space, hyperplane, and the profit space, half space, and the loss half space. So now, if you know in advance that the price vector tomorrow will belong to this half space, it means that you have an arbitrage. Or actually what you can try to do, it is if you know the possible values tomorrow, you can try to find a portfolio or the equivalent separating hyperplane that separates the price vector today from the price vector, the possible price vectors tomorrow. So this is what we are going to look at. So when you have a parametric form, it tells you exactly, actually, it means that you don't know what will be the price vector tomorrow. You don't know the precise values of the prices tomorrow, but you know in advance that the price vector will belong to a certain manifold. So, question: can you separate this manifold, let's say of tomorrow, from the price vector today? So the criterion for this will be to know whether the price vector today belongs to the convex hull of the manifold tomorrow. So here, let's assume in this example that this is the manifold of prices, possible prices tomorrow, because we know that the market is using a parameterization. To take a simple example, let's assume that it's, for instance, a market which is using the Black-Scholes model every day. So every day you have a flat implied volatility surface. So, but this level may move from one day to the next one. So let's assume that the prices, the corresponding price. So in that case, you would have actually two parameters, so the volatility and the spot price. So you have a two-dimensional surface, manifold, in an ambient space, which may be a very high dimension because it depends on how many options you consider. If you take, for instance, a set of 10 options, so at every point in time, you have 10 option prices, or if you prefer a point in dimension 10, and the question will be to know whether, and you know that tomorrow, as the market will follow this Black-Scholes parameterization, the price vector will be on some manifold of dimension 2 indexed by spot price and volatility. So if you prefer another way to, so the question would be to know if this is the price today, how is the manifold? Is it like this, for instance, in which case it means you could be able to separate it by a hyperplane that you can interpret in terms of a portfolio, an arbitrage portfolio. So so the question is, can we separate the current point from the manifold tomorrow? It will depend on whether you're in the convex hull or not. So let's say this is the convex hull. So first case, if the price today is here, the price vector today is here, then it's no arbitrage because you cannot separate the current point from the manifold, that curve, with a line, with a hyperplane. So now second case, if the price today, the price vector is outside of the convex hull, then there is an arbitrage because we can apply again our cherished Brunner theorem and separate the two convexes. The first one being the convex hull of the manifold, the second one being the price vector today, just to point here. And in this case, yeah, we separate like this, and again, we can interpret this separating hyperplane as the set of scenarios that make a certain portfolio unchanged. And so the corresponding portfolio will have a positive value above, negative value below. So the question is to know in practice, in which situation are we? So it's in general difficult to compute the convex hull of a manifold. We'll look at cases where it can be decently easily resolved. So it will be either a low dimension manifold or a linear manifold. So let's look at a very simple examples to start with. The simplest, not totally trivial one. It's just when you have one asset and one parameter, so it's the price itself. So today you are at x0, and if you know that tomorrow the price can only be, here I put some density, but we don't need that. We just need the support of those densities, the set of possible prices. Let's imagine that you know that the possible prices tomorrow are just here or there. So indeed, what you do, it's you first compute the convex hull of this support. It's this half line, and you separate from today, like for instance, so a hyperplane in dimension 1, what is it? But it's just one point actually. So like the current point here. And to separate it, so what is the corresponding linear form? So actually, it's just corresponds to a portfolio which is buying the asset. It makes money if it goes up, which will happen, or it loses money if it goes down, which is impossible under this this assumption. So it looks totally trivial and unapplicable, but actually when you build an arbitrage portfolio, and it means you're exactly in that situation if the x-axis corresponds to the portfolio value. So let's look at something more interesting. So it's what we've just seen before. If you have a payoff like this at time t, so you construct the convex hull, and you have this arbitrage free prices, possible prices here, and if the premium today is below, then you can build the arbitrage by again separating the dot from the convex hull by your hyperplane, which is a line here. And in this case, it means selling some zero coupon and some stocks, constant and linear, and a fine payoff. And so in that case, if it goes through the premium, it means you don't make or lose any money to start with. You buy the cheap claim for this premium, you sell the hedge for the same amount, but at the end, you're guaranteed to make money because you will receive the white curve and pay the yellow curve, which is just below. So by duality, so you know, you have this dual interpretation of this upper bound, lower bound as either as for instance, for the lower bound, as the most expensive self-replicating portfolio, or as the cheapest expectation of the claim under the martingale measures. So here it's quite trivial. It would correspond to a binomial one, but it works in a high dimensions, and actually, in general, it's related to the Crane-Millman theorem and the Choquet theory that says that you can express any point of the convex hull has some measure, some integral under the measure of the extremal points. Okay, another example here. It is, it looks quite trivial, but it's just to show the power of it, because this condition of separating from the manifold or belonging or not to the convex hull, it is an equivalent characterization of the arbitrage. So let's look at, for instance, two call options, same maturity on the same asset, two different strikes, K1 and K2. So you know, if you have a higher strike, you get less right, so the price should be lower. Can we get this result by applying mechanically those principles? Let's look at it. So we have in this case two assets, so the two option prices, and we look at the final values, ST minus K1 plus, ST minus K2 plus, and we have one parameter. So everything at the end depends only on the stock price. And here I'm not even assuming I can trade the spot price. It's not even in the assets here. So let's look at our geometric representation, where so we look at the two option prices, say K1, CK1 and CK2. So here it's the price, the x-axis, it's the final price of the first option, y final price of the second option, and the link of them, it's between them, so it's actually only possible values. It's this kind of a hockey stick. It corresponds to three possible scenarios of the final spot price and the relative position of the ST final spot price with respect to K1 and K2. So first case, if ST is lesser than K1, both options end out of the money at zero value. So all those values are mapped into just this point, 0, 0. Second case, ST is K2. So in that case, the first option is in the money. So X and Y is still at 0 because of the K2 option is not in the money. And beyond the third case, beyond the K, both are in the money and increase with a slope one. So this is the set, this is the one-dimensional manifold of the joint option prices at maturity. So what do we do now? We just look at, as usual, at the convex hull of this set. This line goes to infinity. The convex hull actually is this region of the space. and it describes this gray area. So it gives you exactly the possible option prices today for K1 and K2 that would not be directly arbitrageable. So to understand how it works, let's assume that we have a point outside of it. Here, for instance, if this point depicts the two prices today, so in this case, what do? We separate this point from the convex cell. In that case, it is all this line and the corresponding portfolio. And here, without the stock, it's just the two options. It corresponds to buying the K1 option and selling the K2 option. So you buy cheap one, you sell the expensive one. So you can carry on the same thing and find back the, for instance, the results or the model-free result that butterfly option has to respect the convexity in price relationship. So now, I mean, it was just to show that mechanically applying this procedure, you find back the classical model-free results, not surprisingly, because they are equivalent to this approach. Now, let's look at arbitraging and interpolation. The market, quants are very often using this kind of assumptions to interpolate between the different points. For instance, it could be, for instance, you have a futures market on whichever security, or it can be you have zero coupon bonds of different maturities, and you have to build a consistent interpolation and let's say a model-free, an arbitrage-free interpolation. It could be, for instance, a term structure of variance swaps that you know at a certain finite number of maturities, and you have to decide how to quote a broken maturity not directly quoted by the market, but you're a market maker and you have to provide prices, or you have to revalue your position that depends on intermediate maturities. A classical way to proceed is to compute instantaneous forward values of the quantity and to assume they are flat between market quotes. So for instance, if you have a zero coupon curve, so you can, you have many ways to construct an instantaneous forward rate curve consistent with it, but a kind of simple, usual one. It's just to assume that between two market maturities, the instantaneous forward rates are constant. So you give a non-ambiguous values. If you do it with volatility, for instance, with the variance swaps, so if you started from arbitrage-free variance swap term structure, the finite quotes, then this approach would generate flat, constant instantaneous forward variances between two market maturities. And if you started from non-arbitrageable values, your interpolations will be non-arbitrageable either. So it's quite a classical way to do it. People would do it also for when they have a CDS curve, the different maturities, and they try to find a corresponding intensity, instantaneous forward intensity of default. Typically, they would assume flat parameters in between because it's easier and it remains local. The problem that you have when you do this is when your maturities are expressed in relative terms. Like for instance, the CDS, here you would have the 1 year, the 2 year, the 5 year. It's not a calendar maturity, it's a relative maturity, like typically for interest rates as well. So in that case, it's quite dangerous to have something like this here, this piecewise constant interpolation. As soon as the two levels here are not equal, you have an arbitrage opportunity. So let's imagine that you have a market maker giving you a zero bid offer quote for instantaneous forward rates of okay, the market maker is using a parameterization like this, and let's assume it's a frictionless market so that you can trade at the mid. So in that case, you would actually buy the red dot here and sell the green dot. It would correspond, seen from today to day 30 days and 31 days. Why is it so that you should do this? It's due to the fact that tomorrow everything will have shifted by 1 day, and actually those 30 and 31 days here will now fall into the first the first 30-day bucket, and so you don't know what will be the level of the constant level of this instantaneous forward rate over the first month, but it will. What you know is that the 2 calendar days, 30, 31, will fall into the same bucket, and so the value of red and green will be equal. So you don't know what will be the level, but you know for sure that the spread, so green minus red, which was positive, will end at 0. So you should sell the spread. So it's a very simple example, but a very, very practical, very usual.
Bruno,
yes.
We have maybe 5 minutes at most.
Ah, okay.
If you can.
Yeah. Okay. Yeah. Thanks for telling me. So yeah, the question is, if you want to avoid that, how can you do it? So here the parameterization corresponded to have piecewise constant function, and the parameterization was just to take a linear sum of those piecewise functions. So in this shape, it was, those were the sigma here, the summation of the levels times the indicator of those time periods. Now let's look at, and this was actually generating an arbitrage. So we can address the question, if we stick to linear parameterization, so it doesn't mean that the curve is piecewise linear. No, it means that the shape of the curve, the possible curves are linear combinations of basis functions, capital Fi here. So you know that tomorrow the curve will belong to the space generated by this basis functions. And so if you're in continuous time, actually it means that even for very short time difference, maturity difference, you have to be in the same space. So when you differentiate, you still are in the same space, which means that the derivatives of those functions have to belong to the same space. And as it's a finite dimensional space, it means that after a certain number of derivations, differentiations here, you will cycle back, you will have a linear combination of those derivatives being equal to 0. So, which means that they have to satisfy an ODE, an ordinary differential equation, and when you solve for it, you find that it has to be a linear combination of exponentials times polynomials. Otherwise, it generates arbitrage. And interestingly, the classical Nelson-Siegel parameterization of the yield curve is very similar to this, except that you have varying parameters like the lambda parameter here in the equation. So it doesn't fall exactly in this category, and actually it is generating arbitrage as soon as lambda is varying. So now we move to something quite interesting, how to arbitrage Black-Scholes. Can we arbitrage Black-Scholes? for a long time I thought, oh yeah, it's not difficult. They do this and that, and that's it. Thanks to Ito, quadratic variation, free convexity. And actually I realized that it was not that simple, but still it is arbitrageable. So here, as I had said, yeah, in Black-Scholes, sigma is the parameter that's supposed to be fixed, and S is not. But when we recalibrate, we change the thing that was supposed not to change, and we're going to see whether it creates some problems. So intuitively, it would depend on the convexity you have with respect to this parameter. So let's look at a market where every day we would be have a Black-Scholes flat model. So it looks a bit absurd, but reality is not so different from it. For instance, here it's a copper market. It tends to have quite flat skews, but between a couple of days, the level can change quite a lot. So it's quite a good approximation of the situation I'm depicting. So what I thought would work before, so here I'm doing it in the Bachelier rather than Black-Scholes, it's more symmetric, simpler. I was thinking, yeah, I have more Volga, which is second derivative with respect to the volatility, followed out of the money options, and so I can try to capitalize on that, because at the money options in Bachelier are linear in the volatility. So here, if you look at two option combinations, a straddle and a strangle, it's the same thing, but straddle, so it's a call of plus a put of the same strike. Strangle, it's a call plus a put of different strikes. But if you take them symmetric with respect to the money, so the sensitivities with respect to the variables on the left here, so will be 0, 0, no delta because it's symmetric things. And the Vanna, which is second derivative with respect to the spot and the volatility, will also by symmetry be 0. If you take the two option combinations with the same maturity, you have a proportionality between the vega, the theta, and the gamma. So if you kill one, you kill the other ones. You do it by canceling the gamma. You look at a strangle minus ratio of the gamma straddle, gives you a payoff like a W shape on the right here, and it kills all the derivatives except the last one, the Volga. So you think, wonderful, as soon as the volatility moves, I make money. This is true in the case of Ito diffusion, because you would capture the quadratic variation, but it's not necessarily the case. You can construct scenarios of evolution where actually this thing is not a guaranteed win. And actually,
Bruno,
here,
I apologize. Bruno, I apologize. Maybe we can wrap it up in 1-2 minutes, and we have time afterwards to discuss.
Okay. Yeah, because I thought anyway it was a whole hour, including the questions. But okay,
we have.
Yeah, it is. That's the case. But essentially, you cannot have, if you use the same maturity, you cannot have an arbitrage portfolio. It's due to the maximum principle applied to the heat equation with other variables. It shows that there is no way to have a zero value if all the other evolutions are positive. But if you mix different maturities, actually, and with log profiles in Black-Scholes, you manage to create positions that capture really the volatility or the variance. Here, if you have a butterfly, a calendar spread of them, you manage to capture sigma square. And if you go further with the log square profiles and the 3 maturities, I did not manage to do it with less than 3 maturities. Yeah, you're welcome to try. You can get sigma to the power 4. And when you combine the 2 of them, actually, you build a position. So with 3 different maturities, continuum of strikes, that make money as soon as the volatility will change from the initial one at any time and wherever the spot price is. And I finish with a Heston it is possible to arbitrage the Heston model by looking at the term structure here, which is like this, and combining different maturities. Eventually, the geometry in this case is interesting. So it looks like, we call it a diabolo in France, this bow tie or whatever. In this case, actually, half of it corresponds to the contango shapes, the other one to the backwardation one. So if you assume that you don't flip the slope of the curve, it means you're here, you can create an arbitrage by having this, this hyperplane and the corresponding portfolio. So yeah, in conclusion, essentially, it is very interesting to see that markets are trying to eliminate static arbitrage by using parametric forms, but it tends to generate dynamic arbitrage, or if you want, it leaves free convexity on the table. So I will stop here. Thank you for your attention.
So thank you very much, Bruno. It was an excellent talk. So we have quite a few questions over here. So I will somehow try to arrange them. I'll start with questions from the Q&A. I don't know if you can see them. So we have a question from Raquel Gaspar. So the question is inverting.
How is it in ISEG in Lisboa? Você está bem? Há muito tempo que não estou lá.
Yes, I don't think she can speak, but I'll read the question. Inverting a bit the problem. This can be used to try to learn which parameterization are consistent with market data. Is it correct or not?
Let us say we can beat this in two ways. Either you're a trader and you try to exploit sort of bad market practices, or you're a market maker and you do not want to be arbitraged. The main thing is that, yeah, in short, the problem arises when you're changing something that should not change. And essentially, usually you have some convexity in that parameter. So a way to fight this is to have an extended model where you have, you allow for the variability of this parameter, and so you capture the extra, the cost of this convexity.
Okay, excellent. So we have a question from Peter. Peter, you can turn on your mic if you want and ask directly, or I can read.
Okay, thank you, Igor.
Peter Carr, yeah, I don't see it, but hi, Peter.
Yeah, you don't want me to turn on my video. Okay, anyway, I was just thinking that the Lee model that was sort of famous surrounding CDOs is a model that uses parameters, specifically correlation, default correlation, and let's say is well known to had issues in the 2008 financial crisis. So I was thinking that might be a good example of a peril.
The Gaussian copula, yeah?
Yeah, exactly. What do you think? Do you think that's an example?
That's okay. I've not looked at it in this slide, so it's always a dangerous exercise to improvise.
Okay.
I have to see. I mean, one thing is the validity of the model in terms of its ability to capture historical behaviors. The other issue, the one I'm dealing with here, it is the intrinsic inconsistency of a parameterization. So in the case of the Gaussian copula, we would have to look at what happens when you recalibrate and you change parameters that were not supposed to change. And so we can have some fun inspecting the convex hull and all that.
Okay, all right,
yeah,
thank you.
so I cannot say.
Sure. Okay, thank you very much. Appreciate it.
Thank you, Peter. We have, we are actually almost out of time, but I think we can take maybe 2 more questions. And then, as I said before, we'll stay around. You can ask more questions, I mean, with Bruno and with us in more informal setup. Ibrahim Ekron, Ibrahim, you can turn on your mic if you want to ask the question directly, or I'll read it. So it's up to you.
Okay, so I'm here.
Great, thank you.
So my question is about martingality of separating planes. I mean, I would expect that, I mean, are you able to separate with any plane? Shouldn't some of them be martingales? And I mean, is it relevant? I mean, it's about convex hull then. If you cannot separate with all the hyperplanes, then shouldn't the space of those spaces that you're considering be bigger?
Actually, yeah, you're talking about martingales. I think you refer to the separation in the FTAP, where you were separating the claims and the interpretation of the separating hyperplane. So as I said, was the kernel of the pricing functional, which in turn can be interpreted as a martingale measure. So this is an application of Van Brunner in the space of claims. Here, it's not what I'm doing. I'm doing it more in the scenario space. Okay, if you prefer, if we talk with stochastics conventions like the omega space and the little omega events. So in a FT in the portfolio
Oops,
separating the omega space in two halves associated to a portfolio. So you have a half space of scenarios which are profit and the other one losses. In the case of FTAP, it's not the same space, it's the space of contingent claims that can be seen as random variables, because a random contingent claim for any small omega gives you a value, let's say x of omega, which is the payoff. So it's technically a random variable on the space. So the interpretation again of the separating hyperplane in this talk here, it's not in terms of martingale measures, but really the scenarios that leave a portfolio with no change of value, as what I call the ISO profit one. But it's a bit confusing, the different spaces. It's the same principle, but a very different interpretations. So there is no reason to worry about martingality when we talk about the ISO profit space of a portfolio.
Okay, so I'll ask now the last question and then again.
Sorry, Igor, maybe also you have to clarify. So all this is geometric and not probabilist. So it's really separating sets independently of the probability measure you may have on the sets, on whether it's more or less likely. So it's just a support. Sorry.
So how is the convex? So the question is by Sakin Shanbhag. How is the convex hull, which covers the entire payoff function, decided?
How is it designed?
So, how is decided the convex hull that covers the entire payoff function?
The payoff. Sorry. What is the algorithm to generate it? I'm not sure. I'm understanding the question, but something which is important is that the manifold. So it's the convex hull of the manifold. The dimension of the manifold is the number of parameters in your model, which usually is small, and it's in an ambient space of a dimension which may be very large. I mean, the dimension of the ambient space is the number of traded assets, which can virtually be actually infinite. So and the convex hull depends on your choice of the number of traded assets that you decide to have. So once you have defined your ambient space, like for instance for the Black-Scholes example, you may have just those two parameters, spot price and volatility, and 10 option prices. So at each point in time, you have a vector of 10 prices, and you have to see whether you can separate from a two-dimensional manifold. Well, I don't know if I'm answering
Yeah, I mean, we can maybe the Sakin can ask afterwards. So I think with that we'll conclude the official part of the talk. Bruno, thank you very much for.
Igor, if you don't mind, actually, I just wanted to show. An announcement for
Sure, please.
BBQ. So this big seminar, here it is. Yeah, so it's a very big seminar. We had more than 1,000 signups and 600 online, more than 600 online attendees last session. Next one is Thursday, May 28th with Marcos Lopez Prado at 5:30 p.m. And after we have 6 lightning talks on 5 minutes on several different topics. So if you want to get a reference, probably the best is just to Google Bloomberg BBQ. BBQ is Bloomberg Quant seminar. Bloomberg BBQ, and you should, you're welcome.
Excellent. Thank you. Yep, sounds great. Thank you, Bruno. So, and also I would like to mention our next talk, which is also on 28th, but at 1 p.m. New York time. It would be slightly different. It would be a panel on energy markets, and we'll have 4 panelists. We are looking forward to that meeting. And with this, I'll stop recording, but we'll stick around for additional half an hour. Thank you very much, Bruno, one more time. And thank you to all who attended. Thank you.
Thank you.
Thank you, Bruno.